So I sold GM stock today. It actually went up close to 5%. This is a stock I bought at 34. I sold it today at 37.5, and it actually went all the way to 38.75. I had an order placed at 37.5 and of course wasn't paying attention and it went through automatically. But the reason why I had that order is because I usually go for 10% gains before I sell. So I bought it at 34. So 10% is 37.4. So I placed an order at 37.5 and it got executed today, but it actually went even higher, reached 38.75. So you could say I missed out on about 3%. So I missed out on 3% extra. Regardless, it was still a profitable trade. I made about $3.50 times 67 shares. So I made about $234 minus $10 fee. So I made around $224 on this trade. And if I was in a dividend holding period, I would also collect at least one dividend payment from it. So I bought it September 27th, or it got settled September 27th. So now let's go see if it's part of a dividend period. So yeah, so the last ex-dividend date was September 6th. So yeah, I bought it after that. So that means I'm not going to participate in the next dividend payment. So I'm not getting dividends from that. But still made 10% in less than 2 months, or exactly 2 months. So I made 10% in 2 months. And since my goal is to make 10 to 20% per year, so I'm happy with 10% in 2 months, although it wasn't my full portfolio, but part of my portfolio. But I like to separate my trades, not have all of my portfolio in one stock to diversify the risk. Now, what's funny about GM is that bad news came out today that they're actually closing down a plant in Ontario. So that should be bad news. The stock should drop after that. But because it's part of a restructuring plan, so they've got good reasons to close down a whole plant, stock goes up 5%. That's why I feel many times that the stock price has nothing to do with the company's performance or even the news coming out. Because today news came out that they're closing down a plant, and I thought for sure the stock would drop, but instead it went up even more than 5%. It reached all the way to intraday, it probably went up 7%. So yeah, crazy, whatever. Regardless, made a profit. We'll look for other opportunities now. If not, could even buy the same stock if it drops again. Don't know especially with how volatile the stock market is right now. I'd rather take out any profit I can get. AltaGas also went down pretty hard, almost 8% today, pays pretty good dividends. I read some articles saying that the dividend might be in question, but nothing confirmed, just because the dividend rate is right now close to 14%. So it's pretty high, but there's no confirmation that they would reduce their dividends. So it's at a 52-week low, and right now dividend rate is about 14%. So pretty attractive. I put an order on it, actually 100 shares at 14.5. Today's low was 14.56, I believe. Yes, my order didn't go through, but it's still placed. Got a 1-year target of 21. Revenues in 2014 was 2.4 billion, 2015 2.1, so it dropped a little bit. 2016 2.2. So compared to 2014 it's dropping, but compared to 2015 it went up, and then 2017 it's back up to 2.6 billion. But if we look at profit now, so you can see profit is decreasing from 130 million in 2014 to 91 million in 2017, and it missed the last quarter's estimates. So all this could play a factor in why the stock is dropping, but still doesn't change anything about the company's business model or fundamentals, its capability of generating income, its market share, its competitive advantage. These companies always turn themselves around and the stock price will go back up eventually. So I placed an order on that. Very disappointed that Bombardier dropped today, 7% almost. So because I sold call options against it, I wasn't able to sell. I'm not able to sell this stock, but I could have sold it at 2.5 and made 25%. Regardless, I still own 500 shares at $2. So I'm still up 12%, but I can't sell it until December 21st, until my call options expire over here, which I collected $45 from. And depending on the price that it's trading at on December 21st, I might either sell the shares or just repeat the process and just sell call options again. I made 4.5% by selling the call options in 1 month. So if I could do it again, that's about 50% in a year. So I could make 50% in a year on a stock that I'm holding, and I could eventually just sell at $3 or even $4 and make a decent capital gain while continuously making high returns per year from that same stock. So that's a possibility. We'll see what happens come December 21st, but definitely excited. Snap shares also went up, closing at 6.5 today. So I'm up 11%. I bought a 5.84, but once again, I can't sell this stock because I sold call options against it at $7 at the strike price of $7, and I sold it at $1.89. So I collected about $370 from selling these call options. So I collected about 37% on a $1,168 investment, but with an expiry date in 2 years. So I can't do anything in 2 years unless the shares get bought from me automatically at the strike price of $7. So if the market price of Snap shares go up and surpass $7 and someone decides to buy the shares from me at $7, then my shares would sell automatically. So I'll get my capital gain of 7 divided by 5.85 or 5.84. Plus, I still already have the $370 that I collected from selling the call options. So yeah, everything's looking good today on the stock market. Everything, Dow Jones went up 354 points, up 1.5%. S&P also up 1.5%. Bitcoin is still dropping, down almost 7%. Nasdaq is up 2%, so that's great. So what's been going on the stock market lately is whenever it goes up one day, it goes down hard the next day. So we'll see what happens tomorrow. All the oil and gas companies dropped a bit today. Vermilion dropped, Enbridge dropped a bit. And the stocks that went up, you got L Brands that actually went up quite a bit in the past few days. It reached 28. It was actually a good rally for those who bought it at 28. It was a good capital gain potential right there. Vodafone also went up 6%, closing at 20.91. Amazon also went up 5%. That's great. Should be up a little bit in my account. What am I at? Amazon, I believe I have an average price of 15.15, I think. Where's Amazon? Here, 15.15. I'm up 4%, so that's great. Blackstone, I'm up 7%. Bought it at 32, closed at 34.37. I put an order at 35.5. Yeah, I put an order at 35.5, which is about 10-11%. Could change it, who knows? We'll see how I feel. I mean, it's a safe stock, pays good dividends at a 52-week low. It's a great company. So I'm not too worried about it, but at the same time, I'd rather take my profits and look for other opportunities and just keep repeating the process. I'd rather make 10% every 2 months than make 100% in 5 years, because that 100% in 5 years is not in my control. It's not guaranteed either. It's like, it's like the saying, a bird in the hand is better than one bird in the hand is worth 2 in the bush. So yeah, so that's how I see it. If I have if I have the chance to sell something and confirm some profits, I'd rather do that than think of the potential that I can get from if I hold the stock long term. But what I like about selling call options is it gives me a chance to hold the stock long term, but still get something from the stock while I'm holding it. So it's like dividends, but a different revenue stream from the stock that you're holding. MasterCard went up 5%, so I'm probably up 6% in my portfolio. Yeah, so I'm up 5.5% on MasterCard as well. This is a stock I'm probably going to sell in the 200s, 220 maybe. Air Canada is really an amazing story. If you look at the past 5 years, yeah, let's look even further. I mean, back in August 2012, so about 6 years ago, the stock was trading at $1. Right now, it's trading at 27. So imagine those who bought it at $1 back in 2012 and held on to it and never sold. And now they would have made 27 times their investment. So yes, sometimes holding long term is a great payoff, but at the same time, it's not, these type of returns aren't going to happen with every stock. Personally, if I had bought it at $1, if it hit $2, I would have sold it at $2. But I guess selling call options against your holdings might be a good idea, a good way to allow you to keep holding the stock without having to sell, because you're generating some sort of income or profit from it without selling your shares. So then every month you just keep selling call options until you see your stock going up. You keep selling call options at a different strike price. ExxonMobil went up as well. I bought it at 75 on Friday. It's already already at 77 today. Pays very good dividends. Got a 1-year target price of 89. So this is a stock I'll probably hold until 82.50. Actually, I'm going to put a sell order on it right now. So ExxonMobil. That's if I don't already have one. Okay. So ExxonMobil. Click on it. Click sell. Automatically my order entry window populates automatically. So I'm going to put it at 82.50. Good till canceled. And sell. So sell 14 XOM at 82.50. Yes, send order. So I've got a limit order now to sell this at 82.50 automatically whenever it reaches 82.50. Guess I can put one on MasterCard as well. Blackstone, I already have one. Groupon, I can't do anything because I'm selling covered calls on them. Vermilion, I guess I could put on Vermilion as well. So Vermilion, so I bought it at 32.50. I guess I can sell it at 36 or 37. Let's sell it at 37. Good till canceled. Or what I could do, because it pays dividends, I could probably buy 39 shares of it, so I can have 100 shares and then start selling covered calls on the stock while I wait until it goes back up. That could be another strategy. We'll see what happens. Orders. So sell 61 at 37. MasterCard here, I could sell at, now I don't think I'll be able to buy 100 shares of MasterCard, so selling covered calls won't work for me in this case. So let's sell it at 220. Good till canceled. Sell. MasterCard, sell 6 at 220. Amazon, I guess I could put something at 2,000. So 2,000. Yep, perfect. Send order. TransCanada, I guess I can put something at 57. Yeah, let's put something at 57. Dollarama as well, I could sell it at 40. Limit price 40. Good till canceled. Sell. So I bought this one at 35. Yeah, I can sell it at 40. Yeah. Nvidia, I'm gonna hold on to it. I'm not gonna put a sell order because it's got good potential. It's definitely gonna go over 200, but it could even go higher. So I'll wait. I won't put a sell order on it. And Apple, of course, I might buy some more Apple, so I'm not gonna put a sell order on it yet because it looks like it has more potential of dropping with what's going on in the market right now. So I'll wait for Apple. A lot of people are asking me about Cineplex because it's at a 52-week low, even a 5-year low, even more actually. It's got a 1-year target of 33 according to Yahoo Finance. Right now it's paying 6.6% dividends. If we look at the financials, revenue has been growing. So it grew 11% from 2014 to 2015, 7% or 8% from 2016 to 2015. So growth rate is slowing down, but that's okay. And then 5% from 2016 to 2017. So as you can see, the revenue growth is decreasing, but that's normal. You're not always going to grow at the same rate. Although analysts might evaluate a company on their growth rate, but I think it's not fair because when you first start off, you're going to grow at 100% rate almost. You're not going to continue growing at 100% rate forever. That's impossible. Let's look at net income. Yeah, so net income is very stable, if not decreasing. So from 2014 to 2015, they had a really good growth, maybe even 50%. Yeah, 76% growth from 2014 to 2015. But then after that, their profit has been decreasing. So that's probably why the stock is dropping. They've missed some quarterly estimates. Now, what's good about Cineplex is, of course, it's at a 52-week low. Doesn't have much competition in Canada. Pays very good dividends, 6%. But, of course, the future of the movies is somewhat uncertain right now. I mean, the quality of movies coming out aren't so good. People aren't going to the movies as much. You've got so many other alternatives right now. Netflix or downloading movies for free, even though it's illegal, but a lot of people do it and just watch from home. Even Cineplex had to invest in certain side projects that would increase their revenues, like the entertainment games they have on the side. It'd be good to know the demographics of people going to the movies. If it's kids, usually they're going to continue to buy even if there's a recession. But if it's adults, they're going to start, adults can sort of control themselves. They can control their spending if they have to. So that might affect Cineplex. So knowing which demographic actually generates most of their revenue is important to know if it's sustainable in a market recession. So there's the argument that because the quality of the movies coming coming out aren't so great, so people aren't going to the movies as much. But at the same time, people who go to the movies usually go for the experience of going out and being in a dark room and being focused and watching a movie and being with their friends and having popcorn. So they'll go to the movies even if it's a bad movie, just to see it and judge it for themselves. So it's really hard to predict. At the end of the day, it's all about predicting what's going to happen, predicting market or predicting consumer behavior, predicting investor behavior also, because even if the revenues grow, investors have to buy the stock. For the stock to go up, there has to be more demand than supply for the stock to go up. So not only do you have to predict consumer behavior, but you have to predict investor behavior. So if there aren't any other opportunities on the stock market right now, then definitely I would give this a try. But because there's so many other opportunities, there's no reason to take the risk, in my opinion. Personally, I'm not going to buy it because I think there's other things I'd rather buy. But it's definitely worth looking at, especially that it's at a 52-week low and it's paying decent dividends. But you can see that although their revenue is growing, their profits are not. So it's probably because they're spending more on new investments to generate different revenue streams, like the entertainment systems they have at the side of the movies when you go in. But kids tend to get bored quickly as well. So if these games are meant to target kids, they have to keep investing in more games to change it up and keep it entertaining for kids. So it's definitely capital intensive because they have to keep upgrading their entertainment system. So who knows? I'm not an expert in that field, but I mean, business model makes sense. They buy the movie rights and they just keep selling tickets for that same movie. So yeah, business model makes sense. It's just a matter of what will the consumer do, which in my opinion is hard to predict. So in my opinion, I'm not buying this stock. All right, so if you have any questions, leave them in the comments below. Like always, if you're going to trade on the stock market and you're going to open an account with Questrade, use my referral code in the description below the video so you can get between $25 and $250 back. Thinking of opening a margin account with Investor's Edge just to diversify, not to have everything in one place. So I'll definitely record that and share it. Thanks for watching.